So let's start with some basic overview of some linear algebra. Now, linear algebra comes down to the multiplication and composition of scalar and matrix value. A scalar value is just a real number that we multiply against an array. When we scale a matrix or array using a scalar, we multiply each individual element of that matrix or array by the scalar. A matrix is a collection of values typically represented by m times n grid, where m is the number of rows and n is the number of columns. So again, row columns, okay, in that sequence. The edge length m and n do not necessarily have to be different. If we have m equals to n, we call this a square matrix. A particularly interesting case of matrix is when m is equal to 1 or n is equal to 1. In this case, we have a special case of a matrix which we call vector. While there is a matrix object in NumPy, we will be doing everything using NumPy arrays because they can have dimensions greater than 2. For the purpose of this section, we will be using matrix and array interchangeably. We can express matrix equation as y is equal to a multiplied by x, where a is a m times n matrix, y is a m times 1 vector, and x is the n times 1 vector. Hopefully you remember some of these from high school. In order for you to have a be able to multiply n, the second one, okay, this is row, this is column. The column of the first one must equals to the row of the second one. On the right hand side of the equation, we are multiplying a matrix by a vector. This requires a little bit more clarification, lest we think that we can go about multiplying any matrix by any other matrices. So let's dig into this. Okay, matrix multiplication. With matrix multiplication, the order in which the matrices are multiplied matters a lot. Multiplying a matrix on the left side by another matrix may be just fine, but multiplying on the right may be undefined. So here we are creating two matrices, A and B. Notice their different dimension. A dimension is 3 by 5, 3 rows by 5 columns. B is 4 times 3. The general rule of what we can and cannot be multiplied into which order is based on the dimension of the matrices. Specifically, the number of columns in the matrix on the left must be equal to the number of rows in the matrix on the right. So let me repeat this again. The number of columns in the matrix on the left must be equal to the number of rows in the matrix on the right. In super informal terms, let's just say we have a m times n matrix and p times q matrix. If we multiply the first by the second on the right, we get the following. M times n, the left one, p times q, the right one. So what we get, assuming n is equal to p, we get m times q dimension. So the resultant product has the same number of rows as the left matrix and the same number of columns as the right matrix. This limitation of matrix multiplication with regards to dimension is important to keep track of when writing code, otherwise you're going to get error everywhere. To demonstrate this, we use the dot function to multiply our matrices below. So if we multiply A by B, okay, notice it's 3 by 5 and 4 by 3. 5 is not equals to 4, you're going to get an error. And this is exactly what we've got. 3 by 5 and 4 by 3 is not aligned. 5 dimension is not equals to 4. All right, we know that. Okay, so this results make sense in accordance to our rule. Multiplying a 3 by 5 matrix on the right by a 4 by 3 matrix results in an error, while multiplying a 4 by 3 matrix on the right by 3 by 5 matrix result in a 4 by 3. So hence what we need to do, okay, is to rearrange this a little bit. B, if we recall, we just need to pull this down. B is 4 by 3, A is 3 by 5. So here now we have 3 is equal to 3. We will get 5 by 4, which is exactly what we get here. Sorry, 4 by 5, the other way around. B multiplies by A. Right, having done that, let's move on to the actual finance itself, which is portfolio variance. Let's return to our portfolio example from before. We calculate the expected return of the portfolio, but how do we calculate the variance? We start by trying to evaluate the portfolio as the sum of each individual assets scaled by its weight. Now, this is variance, okay, portfolio variance. Variance is the square of standard deviation. So if we take a look at the variance of portfolio, it's equal to the variance of the individual assets itself. Okay, so you apply the variance function into all of these. Okay, individual asset itself. So S0 to Sn are the assets contained within our universe. If all of our assets were independent of each other, we could simply evaluate this, which is these here. And what you get is basically weight 1 multiplied by the variance, weight 2 multiplied by the variance, all the way to weight n multiplied by the nth asset's variance. However, there's always a however in finance. That's the beauty of it. All of our assets depend on each other by their constructions. Remember, when we were constructing, they are correlated, and in real world is exactly the same. They are correlated in some way. They are all in some way related to our base assets and therefore each other. We thus have to calculate the variance of the portfolio by including the individual pairwise covariance of each asset. Our formula for the variance of the portfolio is basically this beautiful notation here. So you have individual portfolios, let me repeat, individual assets weight multiplied by its variance, and also the actual covariance of all of the assets to each other. So you have this P, or this rho, really. This rho ij is the correlation between asset I and asset j. Okay, so correlation coefficient really is covariance divided by the standard deviation of each asset. This seems exceedingly complicated, but we can easily handle all of this with NumPy by using NumPy arrays. Rather than going into the details of how to derive that, that's not the point of this exercise. Just remember, this is how you calculate the variance, and we just use a NumPy array to calculate this. So first we calculate the covariance matrix that relates all of the individual stocks in our universe. Let's go into the code itself. How do we calculate the covariance? We thankfully have a NumPy function called numpy.cov, which is NumPy covariance of the returns. And when we calculate the actual matrix itself and print it out, and here you have the actual covariance matrix itself. The array is not formatted particularly nicely, but a covariance matrix is a very important concept. The covariance matrix is basically of this form. The diagonal is really the variance of the individual asset itself. The rest are the covariance itself. So each diagonal entry is the variance of the asset at that index, and each off diagonal holds the covariance of two assets indexed by the column and row number. What is important is that once we have the covariance matrix, we are able to do some very quick linear algebra to calculate the variance of overall portfolio. We can represent the variance of the portfolio in array form as using this, okay, the weight multiplied by the covariance matrix multiplied by the transposed weight itself, where C is the covariance matrix of all the assets and W is the array containing the weights of each individual assets. The superscript T on the second W listed above denotes the transpose of W. For reference on the evaluation of variance of a portfolio as a matrix equation, best go to Wikipedia. The transpose of an array is what you get when you switch the rows and columns of an array. This has the effect of reflecting an array across what you might imagine as a diagonal. For example, take our array A from above. If we print A, this is what it looked like. It's a 3 by 5. The transpose looked like a mirror image. So in essence, now it's 1, 2, 3, 12, 6 down this way, 4, 5, 6, 15 down this way. So it's basically transposing. This is what you mean by transposing. It went from 3 by 5 to 5 by 3. But weight here is a one-dimensional array, a vector. It makes perfect sense to take the transpose of a 3 by 5 array, so the output will be a 5 by 3 array. But a one-dimensional array is not quite as intuitive. A typical one-dimensional array can be thought of as 1 times n horizontal vector. Thus, taking the transpose of this array essentially means changing it to an n times 1 vertical vector. This makes sense because one-dimensional arrays are still arrays, and any multiplication done between 1D and higher dimensional arrays must keep in line with our dimensionality issue of matrix multiplication. Right, I think I blah 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 for quite long. So to make a long story short, we think of weight as 1 times n since we have n securities. That makes it so that weight transpose is n times 1. Again, our covariance matrix is n times n, so the overall multiplication works out like so. In formal terms, this is what it looks like. It becomes 1 by 1. 1 times n multiplied by n times n. Remember, this matches, so it becomes 1 times n multiplied by this, and these two are the same, so matches, so ended up taking 1 and 1. It becomes one number overall. Multiplying the covariance matrix on the left by the plain horizontal vector, on the right by the vectors transpose results in the calculation of a single scalar value, our portfolio's variance. So knowing this, let's proceed and calculate the portfolio variance. We can easily calculate the product of these arrays by using dot for matrix multiplication, though this time we have to do it twice. So variance, within it, we have the weights times the covariance matrix, and then we have a numpy dot multiplication of the result of this, which is this part here, multiplied by the external, which is this one here, and what you get is the actual variance of the portfolio. If you want to calculate the volatility or the standard deviation, you take a square root of that, and when you print the volatility, it gives you 0.03. So all of this might not make sense at first glance. It helps to go back and forth between the theory and the code representations until you have a better grasp of the mathematics involved. It is definitely not necessary to be an expert on linear algebra and on matrix operations, but linear algebra can help to streamline the process of working with large amounts of data. So for further reading on NumPy, check out the documentations. Thank you for paying attention. I hope you have found that useful.